So, I don't know how many of you have heard me speak on this particular topic before, but financial preparedness is what I do. So, my name is Esohe Galbreath. I am the founder of Esohe Solutions, and I assist creatives, artists, small businesses in the areas of accounting, finance, and organization. I've probably said this a few times, but I'll just reiterate it. Artists are my absolute rock stars. Growing up, my mom is a creative entrepreneur, serial business owner, trier, but she always struggled with some of the check the boxes compliance things. And so we were often eligible for various public assistance programs, but she didn't complete tax returns. So by the time I was about 14, I started completing her tax returns. I'll date myself, but that's been 29 years ago. So I've been completing taxes for that long, and back then I was actually doing them by paper. So my background is engineering and finance, and after working for UPS and logistics for 12 years, I decided that I was unhappy, unfulfilled, underpaid, and underappreciated, enough uns that I wanted to figure out what I could do for myself and enjoy doing it. And a friend of mine asked me, she said, what do you already find yourself doing for people for free that you would continue to do if you never got paid? And I immediately thought of the things I did for my mom so long ago, but also I married a visual artist and creative who I found needed a lot of the same things that my mom had needed. So that is where Esohe Solutions was born. And this is now my 8th year in business. And so again, artists are my rock stars, and I've been able to translate what I used to do in corporate America and take that skill set and actually be able to do it for people that I love and appreciate. And I often felt like my mom would have had a lot more peace if there had been someone there for her like me. So today I try to be that person that I wish she had that probably would have made things a little easier for us. So with that, I'll get into the presentation. Today we will cover tax compliance, estimated tax payments, standard versus itemized deductions, payroll, business expense examples. We'll speak to some things around the CARES Act and pandemic considerations, W-2s versus 1099s, just a smidgen on NFTs, digital currency, corporation partnership, sole proprietorship, LLC. I get a lot of questions about the difference between those and what they mean for you. And getting ready for tax year 2022. So I know that we're in 2022, but you'll start filing those taxes in 2023. But how do you start getting ready for those items now? So tax compliance, who should file? If you had any income tax withheld because you worked for someone and there was income tax withheld, you should certainly file a tax return. If you're eligible for earned income credit, you should file a tax return. Earned income credit operates on a bell curve, and it's for our lower income earners. And this year it was expanded to actually include single people with no children. You can earn up to or receive up to a $1,500 government credit from an earned income perspective. It used to cap out at $500 if you didn't have any children, so that's not the case anymore. There's a bit more that's there. Who must file? If you earned at least $12,550 last year, you have to file. But if you had self-employment income of at least $400, you're supposed to file. So we see that difference there. So if you work for someone else and you work for an employer and they were withholding certain taxes from you, then you only have to file if you earned over that $12,550. But if you were working independently and you got some 1099s, W-9s out there, if you earned at least $400, then you're responsible for filing. So a quick lesson in compliance. Had a client, tattoo artist, had just started tattooing. He earned about $26,000 on a 1099. Didn't know what to do with it, decided that he wasn't gonna do anything. After a little while, the IRS will file a tax return on your behalf. So that's a low-hanging fruit for the IRS. They see 1099 income out there, and within a year or so, usually you'll get that informational return where they say, we filed this for you and this is what we came up with. So that resulted in an IRS bill of about $5,500 plus penalties and interest. So not filing results in a 20% penalty on anything that you would have earned. So it's not one of those things that go away and it just gets worse. But if he had filed, right, timely, that $26,000 that he received on the 1099, and included some high-level expenses like cell phone, internet, Mileage, the IRS bill was immediately reduced by $1,500, and there also wasn't that $1,100 tax penalty in addition to any interest that was accruing in the background. So we're talking about savings of a few $1,000s by simply dealing with it, because once the IRS files on your behalf, you can always say that, no, that's not right, I'd like to amend it or whatever else, but then the IRS is kind of looking for you. So I'm not saying any of this to scare you, but it's that the bad news doesn't get better with time. So if you know you have something to do, go ahead and take care of it. Deductions. There are two different kinds of deductions. There's a standard deduction and then an itemized deduction. The standard deduction are these amounts. For a single person, $12,550, head of household, $18,800, married filing jointly is $25,100. You don't pay income taxes on those amounts, those first amounts of your earnings. So let's say, for instance, that you earned $12,000 as a single person. There is no income tax that you're gonna pay because that standard deduction exceeds the amount that you earned. There's also itemized deductions, and that includes state income tax withheld, general sales tax, property tax, mortgage interest, charitable contributions, and medical expenses above 7.5% of your adjusted gross income. And so a lot of people ask me, because they have some things that fall into this bucket, but it's either or. So you can either take your standard deduction or you can take your itemized deduction, but you can't have both. For the past couple of tax years, the IRS has allowed a deduction of up to $300 for charitable contributions that you've made in cash, but that's not typical, it's atypical. It's probably one of those tax givvies that's gonna go away. But it's an either or, and so whichever one is greater is the one that your tax professional will usually lead you towards. I recommend that you always look at the numbers both ways just to make sure that you're getting the best benefit. So, some business expense examples. Mileage is a big one. So there are a few mileage applications like Mile IQ and Hurdler that will help you track your mileage, or you can just keep a standard written log, but mileage at 56.5 cents like per mile that you drive is a really good one. Often clients ask about, well, can I just take the standard, like, can I take actual expenses, my car note, whatever? You can, but 95% of the time, your mileage is actually gonna be more, because for those actual payments, you're only allowed whatever percentage of business miles that you drove. So let's say that you drove 20,000 miles last year, 10,000 of them were business related, so 50% of all of those actual expenses, fuel, interest, repair costs for your vehicle, you would only be able to take 50% of those. And again, a lot of times in a city like Atlanta that is so spread out, we do a whole lot of driving and easily accounts for $10,000 or $15,000 in a write-offable expense. Supplies, of course. As artists, you're often buying a lot of materials and canvas and paper and paints and whatever it is that you use. That includes like Adobe software and things of that nature, but all of those things can be written off against any business income that you earned. Business cards, which are kind of going away, right? We're trying to save some trees, but also website expenses, so anything from a marketing and branding perspective that you might have as a cost. Registration fees, so if you paid the registration fee for today's event, that should be included as a business expense. If you pay registration fees for your art shows, you should include those as well. Internet cell phone is a big one. So as creatives, you're like your own business in your pocket, and a lot of times we do a lot of that work on our phones. And so the work that you do on your phones, the work that you do using your internet, those expenses are also tax deductible. And if, for instance, you feel like I only use my phone 50% for business time, then you can take that 50% as usage. If you happen to be a full-time entrepreneur, you might actually include all of that expense. Research and inspiration. So this one often comes as a surprise, but if you have a cable subscription, streaming services, books, travel that directly inspire your artwork, that is a write-offable expense. All of these things should offset some income, and there should be business activity associated with it, but these are all applicable deductions for you as artists. Your studio, home office space, so whether that's studio, home office, storage that you have for your artistry, that is tax deductible as well. If it's inside your home, then we just take a percentage of the total square footage. So if your total square footage is 2,000 square feet and your home office space is 200 square feet, then it's 10% of all of those applicable things, like your rent and utilities and water and trash and sewer. Business meals, those can be celebratory, those can be refreshment breaks, those can be dedicated business meetings. So if after we have a great time at Articulate in July, we want to all go out and celebrate and have a dinner, that would be an applicable business expense that could be written off. Trainings, workshops like this one today, again, can be written off. Next topic is W-2s and 1099s. W-2s are for employees and employment taxes are withheld. Employment taxes are Medicare, Medicaid, Social Security, and account for about 15%. Income tax is generally withheld based on whatever you tell the government, in terms of dependents and what your filing status is. And that information is gathered on a W-4. So if someone has you fill out a W-4, then after the year is over, you should expect a W-2 from that person. 1099s are for contractors, and there are no employment taxes withheld. So Medicare, Medicaid, Social Security, there are no taxes withheld. That 15%, approximately 15%, you're gonna be responsible for. Income tax might be withheld, but it's rare that you see that. So the income tax and self-employment tax are two different things. Income tax is based on your tax bracket, 10%, 12%, 22%, and it is graduated, but the self-employment tax is standard across the board, and it's just a little bit less than 15%. That information is gathered on a W-9. So if someone asks you for W-9 information, you should expect a 1099 from them. If you happen not to receive a 1099, you should ask them for the 1099 just to make sure that it's not out there floating around, that they reported it to the government, but you didn't receive it, which can result in the government filing on your behalf. So estimated tax payments. Do you happen to think you're gonna owe more than $1,000? That's where there are penalties that happen. Estimated tax payments are based on quarter end dates. So quarter ending March 31st, that is due the April 15th. June 30th is due July 15th, September 30th, October 15th, and then the end of the year would be due January 15th. There's a small penalty if you owe more than the $1,000. The penalty is less than a percentage point, but if you don't want that surprise at the end of the year, it's a good place to start. I do tell clients just as a high level guesstimation, right? So if you're not keeping like detailed books per se, typically 10 to 15% of what you earned as a top line number is a good amount to put away for that estimated tax payment. So let's say that you have a freelance gig and it was $5,000. I would estimate that putting away $500 to $750 would go towards that estimated tax payment. That's because you should have all of those business expense examples that we talked about to write off. So when you have all those items to write off, you're not paying on that full amount, but that's just kind of a rule of thumb that I see in artistry for those clients. Next up are the business entities. So a sole proprietorship versus partnership versus S Corp versus C Corp. Lots of numbers up here, but one of the things that I do want to highlight is as a sole proprietorship, you can be an LLC, right? But also a partnership could be a limited liability company, or you could be a limited liability company and operate as an S Corp where you're asking the government, this is the way I want to be taxed. So just because you have an LLC, it doesn't necessarily put you into any particular bucket. There's still conversation to be had about which bucket may be most beneficial to you. So the sole proprietorship, you're taxed at whatever your personal income tax rate is. So those were the tax brackets that we talked about earlier, plus an additional 15% in self-employment tax. In 2018, we got what is the QBI deduction, which is 20% of whatever your net profitability is. A sole proprietorship is eligible for that deduction, and a sole proprietorship does not require a separate return. So a sole proprietorship, you file a Schedule C with the rest of your tax form, and it kind of rolls up and informs your larger tax return. A partnership is taxed at the same rate as the sole proprietorship, and you don't necessarily have to have guaranteed payments. That is also still eligible for the QBI 20% deduction, but a separate return is required. So if you file with the IRS and you say that I have this business that I'm starting and it's an LLC, the next question when you're applying for your EIN is if it's a multiple partner business or if it's a single person business, like single member, multiple member. If you say that it's a multiple member, the IRS expects a partnership return, which is different than you just having it show up. So I have some clients who apply for an EIN, and when that question is asked, don't necessarily understand the fullness of what happens when you say that. And partnership returns and S-Corp returns, the late filing penalty is pretty steep. It's $200 per month per partner. So if you have 4 or 5 partners within a space, it can get really expensive really fast. So just be thoughtful about that when you determine that you want to even start a partnership with a friend, business colleague. Next up is S-Corp, and S-Corp requires reasonable wages, and those reasonable wages would be taxed the same as a sole proprietorship ordinary business income, but then there's no self-employment tax on the remainder of the money. So I have an example a little bit later. The C-Corp has a flat tax rate of 21% and distribution tax rate of 0 or 15%. Which bucket you fall into definitely depends on what your net profitability looks like. And so those conversations happen. And typically I start having conversations with clients around S-Corp status at about $50,000 in net profitability and C-Corp status at around $100K in net profitability. Those are just high-level estimates, maybe different for you, but it's something that you should be considering as your income continues to increase. Because keeping it as that sole proprietorship, you're probably paying a whole lot more in income taxes than you might need to. So the benefits of payroll, and this goes back kind of to that S-Corp. So an S-Corp has to have an employee. The government wants to make sure that you have somebody that they're collecting self-employment tax from because somebody has to be working this thing. There's savings on that self-employment tax because you are doing it proactively. There's less tax burden surprises because you're now on payroll. So as an individual business owner, you say that I'm going to pay myself as an employee. I'm going to pay myself some money. That might be $2,000 a month, $3,000 a month, but now that's being taxed and it's being withheld from the paycheck. And then at the end of the year, whatever the profit is after all of your expenses, including what you've paid yourself, from a payroll, right? Like not you just writing yourself a check with no taxes withheld, but then that is taxed potentially at that S-Corp tax rate and you're not paying self-employment tax on that delta. So it's the self-employment tax savings above and beyond what you've paid yourself in payroll. It also provides verifiable income. So when it comes time to buy homes and the mortgage company is asking for all of the information, being on payroll just made that a whole lot easier. Also allows for easier budgeting because you know what you're attempting to pay yourself every single month. You can budget based on that. Anything above and beyond that dollar amount is a bonus, right? So then you're really treating yourself as a business. So as an artist, you might decide that I'm going to pay myself $3,000 a month, but maybe your profitability for the year was $100,000, and so there's some savings. But here's an example. So no salaries, no wages. There was gross revenue of $150,000, and then expenses of $50,000. So that leaves us with net revenue of $100K. Self-employment tax plus income tax, just high level, $30,000. But let's say you did decide to have salaries and wages. You had gross revenue, the same $150K. You had expenses of $50K, but you had also decided to pay yourself $50K. Now that leaves you with net revenue of $50,000. Self-employment tax plus income tax is now $22K. And for a good portion of that, for that $50,000 you paid yourself in salary, all of those taxes were already withheld. So you've not only saved $7,000, $8,000 in the process of this, but a lot of it was already withheld. And I think that ends up being a big pain point come tax time when you haven't put away taxes. It's like, oh, I made $5,000 and I spent $5,000. Well, you should have made $5,000 and again put $500 to $750 of that away because you're probably going to owe that much later. So some CARES Act information. We received stimulus payments. There was some SBA assistance. There was expansion of unemployment benefits, and there was child tax credit. So the stimulus payments, going back to 2020, that was based on your 2019 tax return or 2018 if you had filed, and individuals making less than $75,000 received $1,200. Joint filers making less than $150,000 received $2,400. There was additional $500 for any dependents under the age of 17. So just to highlight, if you haven't filed a 2018, 2019 tax return, that money is still out there. So I literally have clients who are making up time because they hadn't filed on time, but those credits were definitely helpful in offsetting what could have been some debt. The second round was a 2020 credit advance. So that was based on your 2019 tax return, and you would have received $600 or $1,200. That happened at the very end of 2020, early 2021. And then the third round of tax payments was the $1,400 payment or $2,800 payment with an additional $1,400 for dependent payment, and that happened in March of 2021. And so that credit can be taken on this year's taxes if you didn't receive it. So again, there's some credits out there that make it more beneficial for you to file your tax return. Because when the government files your tax return for you, the one thing that they don't do is look for credits that you may be eligible for. So they file it on their own, and they're not necessarily looking for whether or not you received a credit or didn't receive a credit, or if you have deductions, or if you have dependents, or any of the things that may lower your tax liability. It's kind of worst case scenario. There were also some child tax credit changes where you could receive advanced tax payments for your children. And so it was $250 if the child was under 6 and $300 per month if the child was over 6. And those payments came out like between last July and December. If you didn't receive those payments in advance, you're eligible for them now. So far, that is limited to 2021. We haven't seen that benefit extended, but that was $3,000 or $3,600 per child, which also made it a really good time for you to file taxes if it was something that you were behind on. So I have never had clients who received $7,000, $8,000 refunds, $17,000 refunds. That particular household had 5 kids, I believe. But for taxpayers with children, it was definitely a different time when it came to tax filing. So there were just huge differences between prior years and this year's based on some of these payments that should have been received. The SBA assistance, EIDL, which was Economic Injury Disaster Loans, that money was received. It was administered through the SBA. There were emergency grants up to $10,000. It ended up being really great because these things were not taxable. So it wasn't taxable, but the question that I did have for a lot of my clients who may have received these funds was if the books from this year tied off with the funds that they had received. So if you did receive PPP advances or EIDL advances or anything like that, just making sure that the numbers made sense. And so when you applied for those amounts, some people played with a calculator and was like, if I put in this much, then I get this much. And that's great, but you do want to make sure that just as a follow-up, your tax return aligns with the information that may have been provided. So pandemic considerations, again, the stimulus payments, EIDL, PPP, they were not taxable. Unemployment compensation received in 2020, the first $10,200 wasn't taxable. That did not apply for unemployment received in 2021. There were a lot of other grants and government assistance that was available. City of Atlanta had some additional funds and money, and depending on those grant stipulations, it may or may not have been taxable, but pay attention. Additionally, stock investments. I had a lot of clients during the pandemic were inside and got into trading some stocks and stuff, and just wanted to like a quick reminder that with the stock investments, if you can hold the stocks for at least a year and a day, it's taxed at a much better rate than if you sell prior to that. So just a thought, like if it's coming close, but if you're doing something where you're trading, you know, after a couple months or after a couple weeks or whatever it is, but there are tax implications. So in the same way that you should put money away for 1099 contractor income, if you've made money in the stock market, there should be some money put away. I had clients who made $10,000, $12,000 and they didn't understand why their tax liability had increased, but the government is going to tax that, and so there are going to be implications associated with it. The suspended student loan payments actually did have a negative effect on a lot of people's tax returns because that was a deduction that you weren't taking because you didn't make any student loan payments. So up to $2,500 of student loan payments is tax deductible, the interest, and because there were a lot of deferments during that time and it wasn't necessary to make the payments, then people were a little surprised because they didn't have that credit on their tax return. Working from home. So I will say that as an employee working from home, it still didn't make any difference. Unfortunately, in 2018, they got rid of employee-related expenses that were tax deductible. And so working from home, home office used to be a tax deductible thing, but it's not anymore. So as a business owner, freelancer, you can deduct the home office expenses. As someone working from a company working from home, it is not tax deductible. And then pandemic, side work, side hustles. I noticed a lot of clients just picked up additional activity that they were actually making profit from, but they didn't really consider it income, but they needed to consider it income. And next year, in 2023, for the first time, the PayPals of the world are going to be required to provide 1099 information to you if you earn more than $600 through the platform. So just be aware, be ready, look out for it, but I think that was a bucket that some people didn't necessarily consider before. NFTs and digital currency, just want to highlight the tax implication. If you make any sales in terms of NFTs, that is still reportable income, it is taxable income, and the gains or losses in whatever that form of payment is. So there are tax implications associated with the sale of NFTs. So just because you don't receive dollars in hand, it doesn't mean that they're not tax implications. And although the government, I feel like, is a bit behind in catching up with this wave, it doesn't mean that they won't. So at least just kind of be aware that you are earning income. Digital currency, one of the things that I found really interesting is that if you make a purchase at Starbucks with your Bitcoin, that is a sale because you've had to convert that almost to US dollars. And so in that moment, you've sold a bit of the digital currency. So it can become really messy at tax time, but it's essentially almost like you cashing out on whatever that was that you had. So getting ready for tax season 2022. Secure an accountant, find somebody that you trust, have those conversations. The tax entity formation, so just be considerate of that LLC versus S Corp, sole proprietorship, partnership, whatever it is, and what those tax implications may look like. Consider setting up payroll in advance of the year that it happens. Any stock investments that you have as you're contemplating sales, make sure that you're also contemplating how that may affect you come tax time. Real estate, if you're thinking about selling your home, talk to a tax professional to see how that may affect you. The same thing with flipping properties. I've had some people who've made wonderful flips throughout all of this, but unfortunately there are tax implications with that. And so you can make $100,000, but depending on how long you held the property, there's certainly tax implications in how much you're gonna owe. The suspended student loan payments, we continue to experience extensions on that, and it is great. So figure out what you're going to do with that money. And I don't know about you, but I'm certainly praying that they cancel some of them altogether. And then also this digital currency piece. So just any movement or activity that you're having in that space, make sure that you're thinking about those implications as you buy, sell, purchase goods with the digital currency. That's all I have.